Mr. Brent Donnelly, the author of
Oh,
Alpha Trader. Now, I know, Stelios, it's not your book, but frankly,
it's okay.
that
That one's better, I have to admit.
the Alpha Trader book. But Brent Donnelly is here joining us, and he's actually, one of those guys that I love to have conversations with about the markets, because if you ever go, man, there's still a lot I need to learn. Listen to Brent for a little while, and you'll realize there's still a lot to learn in the markets. Brent Donnelly from Spectra Markets. Good to see you, sir. Glad that you're here.
Hey, Blake. Yeah, it's funny you say that, because I feel like I'm constantly learning too. It's amazing how I've been doing this for 25 years and I'm still learning and changing my opinion on different tactics and methodologies and stuff. It's amazing.
Well, it's weird because the market is always ever changing. I mean, I was having this conversation earlier just with Michael Guyad about, the traditional stock bond portfolios. I mean, how upside down are those people, that have been in that traditional type of market that it's never happened, right?
Yeah, and I mean, these are kind of the glory days of macro right now, because of what you're describing, where like risk parity, you never really have seen the correlation of stocks and bonds, or not mostly in most of our lifetimes, move like this. So there's really no safe place in long only type of assets. It's like macro is king right now, and fiat's even more volatile than crypto, which is rare.
It is, and I told somebody the other day, I'm like, hey, you want a lot of Twitter followers? I don't care what your Twitter handle is, just throw macro on top of it, and you're going to get a bazillion followers.
Yeah, it's so funny. And one thing you said that's funny too is, when people say like, oh, I guess we're all vaccine experts now. Oh, we're all Ukraine war experts now, and kind of like I feel like those comments are silly, because like that's kind of the whole point of global macro, is to try to accumulate knowledge about whatever's driving the current narrative. And like, obviously you can't become an expert in all these things, but you try to have like some working knowledge. And to me, that's why it's always interesting, because the narratives are always different. It's like days like this, it's really about getting inside the mind of the Ministry of Finance of Japan. And then some days it's like getting into the mind of the Fed and all that. So yeah, it's an interesting area to work in, especially right now.
It is. And, I just got a comment that, Brent, you are a legend. And that comes from Zolani.
Don't embarrass me, please.
Hey, I wanted to introduce you, Brent, to one of our colleagues at Forex Analytics, Cohen Vander. I'm sorry, we call him K-Man.
Don't say K-Man, say K.
Yeah, can't say K. Hey, K, how are you?
Special K.
Yeah, hey, hi, nice meeting you, Brent. Dinosaur time.
Velociraptors.
Yeah.
Well,
hopefully.
K is he spent a lot of time on trade desks over the years. I know K's specifically, has read a lot of your research over the years, and he's going to have some great questions as we go through kind of today's discussion. But I just want to make sure I make the introduction, because he's real pleasure to have his experiences, 40 years plus of experience on our team, and I know he's going to have some great topics to talk with you about. But I want to start off with, since today's a historic day, Brent, let's talk about what happened in the dollar yen today. So, what do you think about today's action in the dollar yen?
It's interesting because the MOF kind of got lucky in that daily was pretty dovish. There was a Tim Rayos thing from the Wall Street Journal that sounded a little bit dovish. And like it just goes to show that currency intervention only works if you're going in the direction of the macro story. So if the BOJ is pinning yields at 25 basis points and US yields are skyrocketing, you can sell $50 billion yen and it's just going to bounce back the second you're done. Whereas now, actually, it's interesting today because they've made a pretty decent dent from 152 to 146 is a decent dent. But also you have kind of like looks a bit blow-offy in yields. And then you have BOJ next week. And ultimately the cure for weak yen is to abandon the yield curve control from the Bank of Japan. But it's very hard to understand what they're doing. So the MOF selling dollar yen while the BOJ is doing powerful easing, like it makes no sense. It's like setting a thing on fire and hosing it down at the same time, right? Like it doesn't make any sense. So what the MOF is trying to do is buy time until the BOJ finally pivots. And there's a BOJ meeting next week, so that's going to be really interesting. Now, I think the predominant feeling is that Kuroda wants to stay with the powerful easing till he leaves, which is March 2023. But I mean, at some point, they're going to have to abandon it. It's like it's in a state of disequilibrium. If you look at a chart of Japanese 10-year yields, if you've traded for a while, there's a specific look that things that are out of equilibrium look like. Like if you look at after an IPO, when the underwriter stabilizes it, it's like it goes and then it just starts flatlining along the place where the intervention's happening.
Yeah.
And it's the same thing with Japanese yields. So it's in a state of disequilibrium, and every BOJ meeting is going to be super interesting. But in the meantime, there's so much opportunity to trade, like, you know, just doing put spreads in YCS or however people trade dollar yen. You know, you can just trade cash. Cash is a lot harder than options, as evidenced by like the move up through 150 was so big that if you were short cash, you know, where would your stop have been? Almost anyone's would have got stopped out, unfortunately. But yeah, it's a really interesting situation. And the knee jerk from speculators is to want to buy the dip, but I think that because that worked last time. But I don't think that's right this time, because I think my view is that as we're kind of honing in on where terminal is, even though we don't know exactly, I feel like the range of what terminal from the Fed is going to be, you know, it's getting more and more well known. And so fixed income volatility is going to drop. And I think actually dollar yen is probably making like a major top around here over the next like couple of months.
That's an interesting call. Go ahead, K-Man.
That you're saying that. And the thing is, as well, well, having been so long in the market, I'm been using options quite a bit as well, even when I was a market maker. And you're talking about options, but options today in yen, especially for, call it retail traders or people who are non-institutionals, are pretty pricey, right? Just today, I was checking like just a 1 week 148 when it was trading up close to 152. And that costs even 55 pips, which is for a retail trader can look a little bit prohibitive. Especially there was no guarantee this morning that the Bank of Japan would intervene. But yeah, you can obviously do put spreads and stuff like that. But yeah, so the interesting thing you're saying, the only way for the Bank of Japan to, or for Japan to curb the yen weakness is to abandon yield curve control. But don't you think they are really trapped? Because at the same time, the government is doing stimulus package after stimulus package, and that needs to be funded. And as we know, since Abe came on, rest in peace, Japan is actually in a form of MMT, and they have to continue to print yen to sponsor the government, right? So the MOF is fighting on all fronts against everybody.
Yeah, basically there's trade-offs, and there's no way that they can satisfy all the conditions. Like if you don't want the yen to keep weakening, then you have to change something. So I think what they can do is move the cap from 25 to say 50, or move it to 40 and then move it to 50, and just slowly raise it to the point where servicing costs won't be an issue. But you're right. I mean, you're going to, if interest rates went to 5% in Japan, it would turn into the doom loop like we saw in the UK, where you just basically the MMT works when rates are zero, and it's total insanity when rates are not. And so I agree with you that it's not practical for rates to go much above 1% in Japan. But they can ease the pressure a little bit on the yen by just, even if they went to 40 basis points, which is meaningless in the bigger picture, it just shows that like there is some flexibility, and the fact that there's some flexibility means that the market will then probably be a little bit less excited about buying or owning dollar yen. So if you have the MOF pounding it every once in a while at random, and then you have the BOJ showing like they're willing to move rates, I think the narrative changes enough that we probably put in a top. And that doesn't mean it goes to 130, Whether it goes to 130 or not would just be predicated on what US yields do.
Yeah, that's the thing, and I was just going to come to that. Let's take it from the other side of the pair, the dollar side, because I'm in the chats with Forex Analytics community, and one of my arguments was like dollar yen can only really top when the dollar will top, and then today we have seen. What's his name? Tim from Wall Street Journal. We call him
Timorous. Yeah, Timorous.
Timmy Leaks. And he came out saying that they are going to do 75 and then probably start to look at what they will do later. So sending a little bit of a warning shot out. So yeah, I mean, the dollar is, in my opinion, still the dollar is the one that is going to drive dollar yen really lower when it turns. But will it turn? And if it does, when?
Right. So to me, it's all, like you said, it's all one trade, and the sort of center, the person driving the bus is yields, and then the dollar's kind of like cheering on the bus driver, and then everything else is kind of following it. So like equities and all that are more following. So I would say that ultimately it comes down to what yields do. And honestly, dollar yen, since like, I mean, as far back as I was trading correlation, which is probably like 2005, dollar yen was always a yields trade. And people thought it was an equities trade because generally when bonds went up, stocks went down, or when stocks went down, bonds went up. But that was kind of a red herring, really, as we saw this year. It doesn't matter what stocks are doing. Dollar yen's just a rates proxy.
Yeah.
That is a great point.
Yeah, that then brings me to something that perhaps is a good topic right now as well. Is we talk about the dollar, we talk about the yen, but then we have to talk about trade. What's going on? So, for instance, the yen. One of the arguments in against the yen for now is like the terms of trade, the negative current account, negative trade balance that is also weighing on it. But if you look at it globally, and assuming or thinking that, because we've seen gas tankers now having to wait in ports before offloading, sending prices back down, how do you see this situation evolve? Perhaps on a global side, is if China is going to open up or not yet, or because I think that may be a big driver of what's going to happen as well in the markets.
Yeah, so a lot of the dollar strength this year has been because of the massive terms of trade shock that happened to Europe and to Japan. The interesting thing is like oil's gone from 125 to 85. So that should have taken a little bit of the pressure off the terms of trade side in Japan. And it never really did because yields just kept on going up. And normally oil down would be yields a little bit lower in the olden days. I actually have a couple of charts. If
love to see him. I think you can share his screen.
Yeah, I should be able to do it. Here we go. Wait a second. There we go. Sorry, this is boring, I realize.
Yep.
So that's Germany's trade balance.
Yep.
So that's been a massive shock, right? And that's a big reason why the dollar's rallied, is that a lot of it comes down to cash flows. So like when you sit on an FX trading desk, the big trades, you know, obviously hedge funds are doing what they're doing and all that, but the big trades are real asset movement and terms of trade. So Germany was, whoops, that's weird. Anyways, well, I'll just unshare that.
There you go.
So Germany was getting cheap gas from Russia and paying euros. Now they're buying more expensive stuff from wherever, Canada, Qatar, all different places, and then they need dollars. So you're seeing like the flows have completely changed. And in Japan, the oil importers, who usually are busy between like 6 p.m. and 9 p.m. New York time, which is like Tokyo open, we're essentially buying almost every single day in 2022. So that's one way that I track the flows, is by looking at dollar or any currency, but I'm talking about dollar yen performance by time of day. So if you look at it in the period where the importers are active, you'll see that they were almost buying dollar yen every single day throughout 2022. They've been less active now because oil has come off a lot. And then with regards to China, so I was in Brazil a couple of weeks ago and did a whole bunch of client meetings and stuff. And the big question that everyone was asking is like, when will the dollar turn, or what could cause the dollar to turn? And generally, if you look at all the periods of dollar weakness since whatever 1990, usually a weak dollar comes, like a real weak dollar where it's tradable, not just like a correction from 96 to 99 in euro. Those big dollar down moves come in the context of global growth, usually China and Germany drawing money out of the US and into those other economies, commodity currencies and all that. And so, obviously Germany's sucking wind, UK is sucking wind, China's deleveraging. So the one area I think that there's some hope is that the credit impulse in China has actually picked up a little bit. Mm-hmm. So I think there's a possibility that you might get some positive impetus from China in 2023 once, they're going to open up eventually. At some point they're going to open. But already before they've even really fully opened, although let me just say opening isn't really binary, as we've seen. It's like stop, start, stop, start, stop, start. So there's not going to be like a day where you go, okay, now it's over. It's more of this sort of spectrum. But at some point they're going to be more open. The credit impulse is already picking up. So I think there's actually hope for like currencies like Aussie into 2023. But for now, if you look at like all the things that have been driving the dollar, the dollar just wins in so many instances because you used to have a situation where like oil up was bad for the dollar. Now the US is a net exporter of crude. So like there's just so few scenarios where the dollar sells off. The only real scenario is some kind of synchronized global growth. And we're certainly nowhere near that right now.
Mm. Yeah, absolutely. And I agree with you.
So, K-Man, do you mind if I ask one question? Brent, so based on what you just said moments ago, you are looking at any significant sell-off in the euro, in the dollar to be a net buyer. So like if you've seen the euro trade back towards parity, you're probably looking to short it, maybe dollar yen back to, I don't know, whatever the number is for you, whatever it ends up being, but you're looking to be net long. Is that appropriate, an appropriate view?
Yes, but we have to sort of split out the time horizons because I'm actually short dollars right now. So
I'm with you, but yes, I get it.
Yeah, so bigger picture, yes, I still want to buy dips in the dollar. Shorter term, I feel like, I could go through my whole thesis, but basically over the next few weeks into midterms, I think risky assets are going to do well as like we zoom in on like, when you look through binoculars, it's all fuzzy. That's kind of what the terminal rate was in like January, February of this year. And now we're going like, and I think we almost know what the terminal rate's going to be, plus or minus. And then you had massive tail risk in Europe, which I think has been cut off now because they're supplied for energy and energy prices, to be honest, are collapsing in Europe. So power prices.
So when you tightened up the binoculars, you actually saw a dove when you did that, right?
yeah.
just
actually,
kidding.
Daly joined the Brainerd team today, which is interesting. That's part of why we're rallying today. So in the short run, I am actually short dollars right now, but that's more of like a short-term play into midterms and nothing specific about midterms. That's just like roughly what my timing is.
Sounds good.
And then, but yeah, if Euro's up at 101 or something, then I'd probably be bearish Euro again.
All right. Well, K-Man, I'll turn it back over to you. I
think it's very interesting as well to talk about time horizons because as you say, like into midterms, but then you also cover the ECB, the BOE, the Fed into that time horizon, which could be a big thing because as a fact, no later than this morning, I was saying, okay, maybe we should be starting to be a little bit cautious because the yields were like ramping at a speed which was getting also a little bit unhealthy, and then we had this Wall Street journal guy. So yeah, I can agree with that. But ultimately, if you look at the rates picture, and then the Americas having this not only on the trade and but actually everything is linked these days. There's these correlations everywhere. But if you go to, let's say, a 4.5, somewhere between 4.5 and 5% terminal rate, and they are getting there early 2023-ish. Not thinking about a pivot, but just stabilizing, they will still be at least 2% higher than where the ECB is going to end up, and also probably 4% higher than where Bank of Japan can for instance end up in the next year or so, and then the US and the Americas. I would say really the Americas are they still going to benefit from the far from my bed a bit of safe haven status that is that going to still be playing parts once the winter gets on or after the midterm?
Well, so there's a few things I would say about that. Is that one, generally, I think markets focus more on changes than levels. So you're going to be in a permanent state where US rates are higher than Europe for many years to come. So I think it's all about the relative difference, not the actual absolute level, because the absolute level is already should be priced in based on where the dollar is now. And then it's the change, I think, that markets care more about. And then, so my view is that Brainerd is sort of leading this camp of, it's not really like, it's not a pivot, it's just a pause. And so I think that doesn't really necessarily lead to like a meaningful, we're not going to all-time highs back in SPOOs. But what I think it does mean is that the tail risks are disappearing. So you had one tail risk from the UK, which was this fiscal nightmare. That's gone. You had the EU energy, people were talking about blackouts and businesses shutting down and stuff. That's gone. Then you had there's two views on the Fed. One is that they up and pause. And the other one, which I don't agree with, is they do more of an emerging market style thing where they just keep on hiking. And then as soon as the crap hits the fan, they cut. So they hike, cut. That's what EM does usually. I don't think the Fed's going to do that. I think their DNA is still super gradualist, and they're being forced obviously to be less gradual now. So I think as we get towards the pause, then the scariness of the rise in yields goes down, just because the velocity of the width of uncertainty starts to get narrower. So, but the thing is, all this means, all this stuff that I'm describing, none of it's really bullish. It's just less bad. So we're entering a period that's less bad. You had a lot of risk premium and a lot of tail risk, crisis risk priced into various markets. And in order to take that out, I think you need a rally and you need to squeeze people out.
Yeah.
But that doesn't mean that things are better. Look at UK mortgage resets, for example, is going to be a disaster. People have mortgages that are £1,500 right now that are resetting to £5,500. I know someone that's a real example. Wow. So yeah, and it's not an outlier. People were getting 3-year mortgages when the base rate was negative, and now they're going to be getting 3-year mortgages at 5.5%. And Canada has the same problem. And again, everything just works for the US. The US doesn't have that problem. So first of all, US already deleveraged in 2008. Canada never did, right? The housing never went down, even in 08, basically. So we're still going to see many things working in favor of the dollar. But like I said, it's always about relative change, not levels. So I think relative to how scary things were, let's say, whatever, I don't know, not very long ago, 6 weeks ago. I mean, the UK thing was in September 22nd. So less than 6 weeks ago. If you think about how that felt compared to how this feels, I think we need to reprice back to 4,000 in S&Ps or something, and that'll probably bear stocks again.
Brent, let me take a pause for one moment and just say, I've been reading AMFX, your newsletter, for years now, and it was really predominantly institutional newsletter that went to every bank desk pretty much across the globe, super popular. And now you give access to the everyday trader, which we'll talk about at the end. But it just really says a lot about what you know in the markets. So we'll talk about that in a few minutes. But I also wanted to discuss just really quick, when you talk about the markets, you typically approach the market more of a swing type of trade. Why is that?
I'm not sure what you mean. Like, you mean time horizon wise?
Time horizon wise. I'm sorry. Yeah.
So the thing is, my time horizon's pretty short, but I look at the big picture in order to make my trades. So generally my time horizon is like 3 hours to 3 weeks. I very, very rarely do anything beyond 1 month. Like if I'm doing options or whatever, usually it's like 2 weeks, 3 weeks kind of thing.
Yeah.
I think just over time, I've just learned that that's what I'm good at, and it fits my personality. Like I tend to overtrade. I tend to like want to be too big and stuff. And so that works okay in short-term trading. If you, as you kind of said earlier with your program, you got to automate your stops. I mean, that's a big thing for me, is just take the discipline out of your hands and just put it on a computer somewhere. Like every time I put a trade on, I always put a stop in the system. Because I just like, why, even if you have great discipline, why force yourself, why test it, just automate it. So, but many of my trades actually will sometimes be like 3 days or whatever. And what I'm trying to do is kind of like, I mean, it's never easy, but like what I'm trying to do is catch like the easy part of the trade where I can feel the narrative shifting. Like a lot of times that's what it is that there's an established narrative, and I talk to a lot of people, so I get a sense of like, oh, that old narrative isn't really true anymore, but people are clinging to it, or people don't even believe the narrative, but they're just like they're too intellectually lazy to get out of the position. And I feel like that's a little bit what's going on with the dollar right now, is that it's just like, it's easy to just always be long dollars this year, and it's been a good trade, and that's mostly what I've been doing. But I feel like quite a bit has changed in the real world and in the narrative world. And sometimes prices just slow to react to it. But what I'm doing, it's not like stuff that's going to go on for 6 months. Like I don't, honestly, I also look at it a little bit like weather forecasting, where if you're dealing with an extremely complex system and then you iterate and iterate and iterate, like there's no way you can predict where things are going to be in a year. This is my philosophy anyways. Like, so I like to bring it in and go like, okay, in the next 2 weeks, I know what the events are. I have a pretty good idea of positioning. I know, like into ECB, this will probably happen. The Fed, I lean this way, the asymmetry is there, and I can kind of put like, that's already getting pretty complex. Imagine trying to think of like where things are going to be in a year. Like I just think, and I mean, the evidence proves no one can forecast, like humans can't forecast out that far. Like
it's a fool's errand, isn't it?
It's and it's crazy, because I've been in the markets for a while as well, and I was looking at, because I compare this period that we are living now in those yields rising, and as one of the other interviewees also very rightly said that Powell is one of Volcker's disciples, or had Volcker as a teacher, and I'm really comparing these. I started really early 80s in banks, and I find so many similarities between what we are living now and what Volcker was doing in those days. And it was also very easy to be long dollars, but it doesn't always happen. And you say something really very, very interesting as well about stop losses, and that's the thing that, when even being very old and well, supposedly wiser, which is for a trader never the case anyway. Yeah, I always do put stops as well. So I mean, that's an absolutely great point for everybody who is watching what you're just saying. And the other thing which is very, very interesting is your time horizon. And especially I noted down something, and you started to talk about also the catching of a move. Not to try and get the absolute top or bottoms, we just can't, right? So you, as you say, write the easy part of a trade or of a trend, and that's exactly I agree with that. And then, but the question that I have about this, and since you've been in the market for that long as well, has your view or your positioning, your time horizon size of your positioning? Has it changed since the pandemic or since 2018, 2019, some switches? Has it changed? Because we've been through, what is it, a double economic cycle in 3 years' time? Has it changed?
No, not really. Because I feel like sure, my position sizing has changed because volatility is higher, but no, it really hasn't. I feel like I'm always kind of looking at like the really big picture, but then really focusing in on like little windows of time, and a lot of times it's like through events or just through specific points where the narrative changes or news or whatever, and then really just trying to surf those little moves. And so to me, the fact that, you know, markets are more volatile and things are moving more, it's more reflects that my position sizes would be different, but it doesn't make me change my time horizon. And just to be clear, like, I mean, there's plenty of people that paid rates because they saw inflation being sticky and held it for a year and made money. I'm not saying that's impossible, but that's just not what I do. Like, I feel like you have to kind of have your time horizon and know what you're doing and know what time horizon you're on, because otherwise when you start mixing them up, like the classic thing is like the shitty trade becomes an investment kind of thing, right? You buy a stock and it goes down. You buy it for a trade and it goes down, then you're like, oh, let me look at the fundamentals of this company look pretty good. I've seen that quite a bit. So I feel like just at least knowing for sure what your time horizon is, and ideally you want your time horizon to match your personality too. So my personality is very risk seeking and over trading and stuff like that. So I'm better off, you know, like, so if I have a 3-month idea, after 2 weeks, it goes up 2.5%. I'm just like, I get bored of it and I take it off. And so I don't do I do suboptimal things. And one thing, just going back to the stops thing, I don't want to beat it to death, but one thing I will say about that is, I think a big step that I took forward in my trading when I was like, I don't know, in my 30s, like it was pretty far into my career, was not trying to fix everything that's wrong with me, and instead just acknowledging it and saying like, okay, I have bad discipline. That's kind of like who I am. Like, you know, I have trouble leaving the bar at 1 a.m. when I know I should be leaving, kind of thing, you know, like that's kind of my personality. And I know that. So instead of that, like, okay, there's two aspects. One, some things you can improve, like conscientiousness is something that you can improve over time, but some things maybe are inherent to who you are, and you're better off just creating systems that deal with it. So I advanced my trading a lot when I said, okay, I have bad discipline. I'm just going to accept that. And then I'm going to like automate my stops. I'm going to create friction so that I'm not over trading. Like, don't trade on your phone. So when I worked at Citibank, we had, we could trade on our phones. Like City Velocity is like the system that they use, and they had a phone version. And so two things about that. One is that, like, guess what? Everyone traded like 3 times as much as before. And it was the most profitable segment of trading for City Velocity, because it's just like dumb, uninformed trading. Like, even if you're a professional trader, if you're sitting at 7:30 p.m. at home after dinner, looking at your phone and then like buying 50 million euros, it's a dumb trade. So what I did was like, I got the app and I was like, ooh, this is exciting. I'll be able to, you know, trade dollar yen and stuff. And then I was like, okay, this is stupid. It's just feeding the dark side of my being. Like, so I just deleted the app from my phone. So I think there's something to be said for just like acknowledging that some weaknesses cannot be fully fixed. And then what you want to do, instead of trying to fix the thing and banging your head against the keyboard, is put systems in that either create friction from unwanted behaviors like that, like delete the app from your phone, or automate the wanted behaviors like stop losses and stuff like that.
No, I'm absolutely, and I think that's something, and I hope our viewers are really taking note of this really trading lesson, and as you say, you have to go through the process of knowing yourself when you are a trader. So it goes automatically by making mistakes, by over trading, and but we have to go as a trader through this process just to get to know how our weaknesses and understand what we really understand. So that takes work, and and it's you can't just sit in front of your PC and start trading without starting a little bit of a self-knowledge process, right?
Right. And I think, and then accepting that there's going to be shortfalls from that. So like one thing, when I worked at a hedge fund for a few years, and I used to talk to the guy next to me. He's a really good trader. I mean, he's been there since 2007. He's still there. So that's 15 years, a long time in a hedge fund. And so I'd be looking at stuff, whatever, and I'd be like, man, Sterling Swiss looks really good here. And I'd buy it. And then like he'd be, oh yeah, that looks pretty good. I'll buy some too. And then 2% later, I'd get out and I'd be like, oh, sweet. And then literally 2 weeks later, the guy would go, oh, that Sterling Swiss that you said was really good. And yeah, I'm just covering it now. And he'd make like 7.3% on the trade. And I'd be like, it used to really bother me. And then after a while, I was kind of like, okay, I'm just doing what I'm doing and everyone else can do what they're doing. And don't play someone else's game. Like understand what your game is. And it's hard, like, you know, especially if you work like if you work at a place where there's a lot of peers, it's easier when you're trading from home because like you don't really have like 6 other people. You don't have the FOMO as much of like 6 other people having a trade on, and then you're like, oh, I'm gonna feel stupid if I don't have the trade, and they make money and stuff like that. It's
actual
really
peer
important.
pressure.
And in an institutional setting, I remember actually the first, like this was another like big breakthrough for me, was I worked at a bank and the boss man there was like super, like 6'5", huge hands, super charismatic guy, super loud. He was kind of like a god in Canada, in trading in Canada. And I remember like, so he always was super loud about his views, like, and it was always dollar Canada. And I remember one day going like, you know what, I don't care. I know he's bearish, but I'm bullish. I'm going long. And that like the ability to, that was when I was in my 20s or whatever. And I remember thinking like, ooh, this is kind of a breakthrough because I'm just doing whatever I want now. And I think that's really important. Like you can't be influenced by other people's views too much. You can listen to them and incorporate the information. But I think what you want to do with other people's views is understand the underlying reasoning for the view. If someone just says they're bullish, it's meaningless. Like who cares? Yeah. Even if it's Alan Howard, to me, like, you know, or Druckenmiller or whatever, unless I know the reasoning, I'm not just going to be bullish because that guy's bullish. Like, I don't even know, maybe he's going to flip tomorrow because his reasoning changed. So I like talking to people and understanding their reasoning, but then using that reasoning as an input into my own decision-making.
Yeah. And
that is
yeah, go ahead.
I was going to say that is awesome. I wanted to, you know, we got a few more minutes left with Brent. Nigel asked a question about China, so I just wanted to get to that. And if any of you have any questions for Brent, bring it, because so he's you know, this is one of the great things about being at the Trader Summit is being able to ask some of these all-star traders, economists, you know, how they think about things. So bring those questions. But real quick, K-Man, Nigel asked, what are some hints of China's zero COVID policy U-turn that you think are maybe tradable? Like, what's something that China could say that you could try to incorporate that right into the markets?
Well, I mean, the ultimate thing would be that they make an announcement like Singapore did, like living with COVID kind of thing. I feel like that's very unlikely, although like I'm not an expert on Xi Jinping, but it seems like it's sort of like become part of his brand to prove that zero COVID is a good policy, even though not one person in the world seems to think it is. So that's the thing, is that I don't think there really will be a defined binary moment where you say, okay, zero COVID's over. It's going to be more like, if you think about like how COVID ended in the United States, it's just kind of like you look around and one day barely anyone's wearing masks. And you know, there was gradual changes in policy and rules and stuff, but I feel like it's not going to be this binary moment. So if you want to trade it, you kind of have to, like, say you're doing Macau casino stocks or whatever, you just have to kind of make sure you have a good enough entry point that you can ride it until slowly the market just decides, okay, China's opening up.
Or like, you know, buying the Aussie dollar today because there's been a nice 3-week base in it. Wait, did I just say that out loud? I'm sorry. I'm joking. Free
money, long Aussie, free money.
Wait, what? I'm sorry, couldn't hear what you said. Yeah. Gallup said, asked Mr. Donnelly, when do you release the trading almanac, and can we see a little demo for the Trader Summit?
Sure. So it's actually done and
Ooh.
it's ready, but the problem is there's like a process that you have to go through with like the proofs. This is boring, but with the proofs when you create a book is basically like clearing them so that the format's right and the gutter is all right and all that stuff. So I'm waiting for that. It should be any day. I have some.
And there he went.
I have.
Oh, there he is.
I'm out of here. Thank you, New York. So this is what it looks like.
Oh, awesome.
And then basically on the inside, there's like a place to write your plan and your views, and then major events, and then seasonals. Because one thing I found with the seasonals, so, and then at the back, it's like the average seasonal performance of 26 assets throughout
Holy
the
cow.
year. But the problem I find with seasonality is that I just forget a lot. So you're like, oh shoot, this is like the period. Like I'm always aware of the equity seasonality, but there's a lot of other ones in FX and gold and stuff like that. And I just find I forget. So I was actually just going to do this for myself. And then I was like, oh, this is kind of a cool product. I think people would like this. So I started with I have like a daily sheet on the daily sheet.xls, which is just like my thing that I print in the morning, and I write down my plan, my views, some levels and stuff like that. So I started with that as kind of like the blueprint, and then added, and Justin, who works with me, we went through and put in, so like here, this is July, I just opened to a random page, July 24th, entering the worst seasonal period of the year for New Zealand dollar now until September 5th. So like, just kind of letting you know. And like, I think you can't overweight seasonals. Like you can't just, unless you have a system, which you can't, people do trade them systematically, but as a discretionary trader, I feel like seasonals are a useful input. But like for me, my trades are never predicated on one thing. It's usually like a whole bunch of things coming together. So seasonals are, to me, are important, but never a thing that you would just like. I don't just trade seasonals outright. I would incorporate them as part of my decision-making process. Like right now, it's a lot easier for me to be long equities than short because the seasonality into midterms is really strong. But I'll still go short if enough other things, if the wind's blowing,
Sure.
six other things point down and seasonality is the only one that points up, then fine, I'll be short.
Right. Yeah, that makes a lot of sense. Hey, Cayman, did you have any other questions for
Well,
Brent? He's got just a few minutes.
Yeah, I was just going to drill down to one country here, and that's Canada. Because
Since
Canada
he resides in Canada.
Sorry?
Yeah, I'm from Canada.
He resides in Canada.
I
No,
know,
I
know.
in the
That's why.
States, but-
That's why I saved the best until last. So, and I know that. And yeah, I was going to ask about Canada because, to be honestly speaking with you, I think there's still a lot of good vibes going around in Canada. Also because they are exporting now, gas and other stuff to Europe, and part of this Americas bloc, at least gravitating around the US. So what's your quick view? Because I know Blake says we only have 1 or 2 minutes left, but your quick view on Canada, if I may.
So the problem with trading CAD as a currency right now is that all of the beta is just S&P and risky assets. So if you try to trade off the Bank of Canada, actually the two hawkish Bank of Canada meetings were the lows in dollar CAD. So basically people tried to buy CAD on hawkish BOC and it just doesn't work. It's not trading like an idiosyncratic story. Same thing with Aussie. So like you have these massive terms of trade booms for both Australia and Canada, but they're not flowing through to the currencies because they're not leading to any capex. And so usually the transmission is commodities go up, companies invest, new jobs get created, that creates growth, and then the central bank hikes, and then the currency is strong. And that's what happened like 11, 12, 13 during the first commodity super cycle. But this time now, when commodities go up, what it's doing is just generating windfall profits for shareholders. But it's not creating any new capex, partly because of like ESG concerns. But also a lot of the stuff's just tapped out, right? So like there's nothing left to do in the oil sands in Alberta. And so there hasn't been any transmission. So like if you're looking at the currency, to me, or the Canadian economy, you just can't trade the currency on it. And then I'm a little bit more concerned about the percentage of GDP that housing is responsible for in Canada is much higher than the US. And then these mortgage resets are going to be bad. So I think from on the rate side, like anyone that thinks global yields are topping or are going to top in this area, I think Canada is a really good place to receive rates, because I think the BOC at some point will see this cliff. So a lot of mortgages are 3 years in Canada. So the big boom was late 2020, early 2021. That's like when the craziest part of the boom was. So if you add 3 years to that, that's like the end of 2023, there's going to be a cliff where people are going to be resetting from like 1% to 5%. And that's just like borderline catastrophic for a lot of households. So I think the Bank of Canada, as we enter 2023, they're going to go from like raging hawkish right now to much more dovish. But again, like I said, it's not a currency trade. Unfortunately, it's just a rates trade.
All right, that's great. Thanks very much for that.
Sure.
You know, Brent, we were just we were talking behind the scenes, and we're gonna be giving away to 3 lucky registrants of the Traders Summit. We're gonna give away 3 of your books. So
right,
3 of your
awesome.
3 of your Alpha Trader books are going to be going to 3 lucky winners randomly, along with our other giveaways too. So, and I can't say this enough. This is really one of the best trading books that I've ever had the opportunity to read. And I've read a lot of books over the last several years, several being 25. So, Brent, well done. Can you tell us, especially the traders that are not so familiar with like your work, especially with AMFX, can you tell us a little bit about what you do and how people can follow your work a little bit more closely?
Sure. So mostly I worked for banks for most of my career, and I wrote a daily that sort of like got more and more popular. And now I work at an independent place where I cover hedge funds and sell FX derivatives. But I write my daily, which is called AMFX. So I've been writing that since 2004. It's pretty short, like it's punchy, like usually 1 or 2 pages. And I just talk about like one theme that's on my mind that day, usually related to global macro, FX, crypto, a little bit, equities. And there's usually like an ongoing story that's kind of going on through each note, but each note kind of stands alone. And then I put my trades in there in real time as well. And people can go to Spectra Markets. I'll put it in the chat, but spectramarkets.com. So there we go. I'll just put it in.
Yeah, I actually put it up there too for everybody.
Cool. Yeah. And so people can sign up, and there's also some random silliness in there. My intention was always, like from the day I started, is to make it like it was always written for institutional investors, so it's somewhat professional, but like trying to not make it boring. So like trying to make interesting observations and like trying to make like write it in a decent, interesting way, kind of thing. So that's what I'm aiming for.
You are definitely a talented writer, and I love just some of your wit and humor behind what you write is just, it's awesome. So I'll tell you, Brent, I've always appreciated your work. I'm so thankful that you got to bless us here at the Trader Summit community with this time. It's ever so valuable, and we do appreciate it, especially on a Friday afternoon. K-Man, did you have any last words for Mr. Donnelly?
No, I'm just saying that it was a very, very happy to meet Brent and to meet you and to have a chat with you among dinosaurs in the market. So we'll do it again soon.
Awesome. Yeah, that was fun. Thanks, Blake. Thanks, Kim.
All right, thanks, Brent. Have a great one.
Thanks very much.
Okay, have a good weekend.